Good day, fellow investors. What happened last Friday isn't a crash, but it perfectly explains the risks of this market. It's simple. The exit door is small. So Wall Street fell 2% in an hour because suddenly, after 6 months of just growth, stability, growing expectations, we are back to trade jitters, China, this or that. But that even isn't the key. First, stocks, oil, crypto went down and treasuries and gold stayed up. If we look at oil, significant decline on less trade, on perhaps recession or everything, really declined over the day. However, something that I would expect to go up when there is turmoil because people rush to safety also went down, which increases, let's say, the concerns that this might not be a safe haven asset, but just a hopeful safe haven. On the other side, gold jumped a little bit and then stabilized for the day. However, treasuries thus still, as people were going away from stocks, bitcoins, everyone went back to the treasury safety, and the yield there even went down a little bit. Even if I think this is a lot of short-term trading, the dollar lost a little bit against other currencies. So this is not a crash, but it explains the risks of this market, from valuation, recession, growth, debt, all factors that we're going to touch on it. But at the end, all these factors will paint one picture, or better to say, one theater, and then, okay, the market is big, there's plenty of money. However, if there are no fundamentals when you're investing, it all depends on one door. And the market has been going nothing but up stably over the last 6 months. And when stocks just go up, people start to get excited. The day before, Bloomberg was full of 9,000 S&P 500. The Fed cuts, everything great. And maybe already this Monday or this week, there will be a plus 4% for the S&P 500 as Trump retreats or says something nice out of China or things like that. Similarly, huge bets last week, everybody exuberant, and cold shower on Friday. So let's go into these risks, starting from valuation. Valuation, the Shiller P ratio now is 40. 40 was higher just during the peak of the dot-com bubble. The historical average is 16, so just from that perspective, stocks are extremely expensive. Okay, might be important, might not be important. The question is, what might revert valuations? Well, interest rates, recession, AI hitting reality, growth concerns, geopolitics. And then we could simply revert to the CAPE ratio below 15 that was, let's say, in 2009. That would mean that stocks would crash more than 50%. Then again, if there is a clear recession, and when there is a recession, everyone expects, okay, recession 6 months, then we get out stronger. But given that we haven't had a recession for the last 15 years, the market might think differently when it will be clear that there will be a recession, and therefore we could have a 30% crash in 15 days. Jamie Dimon, he says there is a 30% chance of a US recession in 2026. He's been saying that every year since 2012. But okay, the real recession will happen when all these, let's say, financial house of cards revert, like private equity, things like that, when they are borrowing at 3% to buy something that has a 4% yield. And that, when that interest rates changes, when the Fed loses control against inflation, that we'll discuss in a second, that's the key risk. Another, not to risk, a certainty is slow growth based on demographics. If you push immigrants away, that means that there is even less poor people to pull out of poverty and bring to, let's say, normal wealth levels, which is the biggest driver of GDP growth. On top of that, slow demographics, huge deficits, big debt burdens that are just growing in relation to GDP, and then net interest payments that are just higher and higher. And if you have such high debts, To refinance those, you need to offer investors higher and higher yields, and that is exactly when the Fed will not be able to lower rates. Or you print money, but then you destroy the currency. And this higher rate, lower rate is also something that will weigh on other things like pension funds, private equity, that is also in a bubble. And when you discuss that growth, all these assumptions that are already totally unsustainable and crazy, and then you look at the assumptions, and all the assumptions by the budget office are for stability. 2% growth into eternity, low interest rates for the treasury, inflation in control, no unemployment, so no recessions at all. But on the other hand, we already see this from a decade of very low interest rates. The 30-year treasury yield has already practically doubled. So from 2% to 4.6, almost 5%. That's a big deal, especially when the US Treasury is borrowing at a higher cost than crazy Italian governments. So 30-year Italian bond is, let's say, lower yield than the US bond. That's already a big warning. However, you say, Sven, everything still looks good despite Friday. Yes. To go into Nassim Taleb, the Turkey feels great as long it's fed every day, but he doesn't know that the risks are just piling, because the fatter the turkey gets, the more slaughtered it will be for Thanksgiving. Isn't Thanksgiving coming soon? Let me know in the comments. On the comment of we can print us out of debt, that's simply just print money, the Fed just invents money and that's it. Okay, if the Fed invents money, will you go to work tomorrow for the same salary, for the same dollar or euro that you are getting now? No, you will say I want more, as much as the Fed printed. And you can see here, despite the job market being bad, whatever, inflation is growing. So it was declining and now back to growth. I hope the Fed and everyone, ECB, can control inflation forever. However, with bad demographics and huge populations growing globally, there will be a bigger fight for commodities, for labor, for this, for that will too have an impact on us. Maybe not today, maybe not tomorrow, but in the future for certain. Then geopolitics, Trump threatens with tariffs, with this, with that. We don't know what will happen, but given the situation in the world, the risks are that you never know what can happen and something can happen. Just because you don't see the white of the eyes of the risks doesn't mean that there aren't risks. But as long as the markets go up, nobody cares. However, the risks are there, and given the situation, piling. And then on AI, the question is, everyone is now investing. We are going to invest trillions in US AI. But who will force me to use US AI 5 years down the road? Won't I be able to just buy Chinese AI that will likely be cheaper, or will use just US AI to do the same for cheaper, as China has been doing for the last 30 years? It is how it is. I might not like it, you might not like it, but that's the reality. And it's unlikely that that reality will change. Therefore, the trillions invested have a big question mark when it comes to investment returns. Because everybody usually, as far as I know, when you invest your money, you want to get it back and more sooner or later. So that's the crazy thing. Plus, just a note here on DeepSeek from China, it was made without any engineers having US education. So it was all made by Chinese with Chinese education. And it is comparable with the American counterparts. 25 years ago, China was 1% of the peer-reviewed published articles. This is from Statista, 2018. 20% and likely even more. So China is there, the rest of the world is growing and in technology and everything. And keep in mind, everybody can use the technology. It spills over pretty fast. And the users of the technology are usually also the gainers. Then we have other things. black swans that we can't even discuss because we simply can't see them, but they can come. Floods, who knows whether this or that natural disasters that happened in history, that's let's say a gray swan. And the white swans are the government debt, the valuations, the risks, the AI investments that we all see there, but we just don't know when those will, let's say, materialize. I hope never, but that's just my hope. Then also something to talk about, it's the speed. Because the market, let's say, took 1 month to reach new all-time highs, and in an hour it was back to the beginning of the month. So Friday, 10 October, past month, nothing. In an hour, what went up for a month? Nassim Taleb always says, it's not about how big the market is. Especially, I think, if it's not based on fundamentals, earnings, dividends, it's all about getting out of that theater or the market, but when you're getting out, nobody's focused on how small the door is. And this 1 day, 1 hour, 2% decline shows how the door is small. And this is just on Trump saying something. If all these risks on the right materialize, and that usually happens all together, the door will be closed to get out, sell everything, and then the clerk replies, sorry, to whom? That's something that one should keep in mind when it comes to investing, because it's always about risk and reward. Be hedged. Check on my research platform how I am hedged. Thanks for watching. I'll see you in the next video.